but now you'll get a chance to figure it all out. Here gives a nice review of cash control, how to keep our cash assets safe, petty cash, and bank reconciliations. Okay, so definition of cash and cash equivalents. So this is very detailed over exactly what cash and cash equivalents are. You basically can just read this on your own and make sense of it, put it together. Specifically, it lists exactly what cash consists of when we say cash, and then cash equivalents. So we talked about both when we were doing the balance sheet and the statement of cash flows. Here it's gotten a little bit more specific. So just trying to look if there's anything that you can't figure out. Sometimes people think savings accounts are investments. They're usually classified as cash. So that's not savings accounts where you're holding investments, you know, kind of a mutual fund combined with a savings account or something like that. Then it would be an investment. But just a savings account is cash. And cash equivalents are things like treasury bills, so these are short-term bonds issued by governments. Commercial paper, unsecured short-term debt, issued by corporations. There are a lot in mutual funds and things like that. Money market funds, type of mutual fund. That invests in high quality short-term debt investments. So you know, all of these are debts. So they're not investing in stocks here. And then here are term investments. Now, with this non-equity, highly liquid short-term investments, that's what I'm talking about. Because non-equity, they're a little more secure. Okay? Now, I suggest you read this and then maybe read the text also. And do exercise 7.1 before doing your Wiley Plus homework for sure. Okay, so read those definitions, you guys. I could read them all to you, but you've got to learn them, so you might as well read them. Now, just onto the next page. The short-term investments in particular include debt investments maturing in more than 3 months, equity investments which are able to be converted to cash within the year operating cycle, certificates of deposit, so a promissory note from a banking institution will be cash equivalents depending on maturity date. Now, this is a small detail, but you know how you can have a draft, and I know we've talked about that before. So let's say you have a checking account and it's in overdraft, right? Which is they let you go below a balance of zero, so you're borrowing money from them. And you might have a limit of 1,000 or 20,000. If you're a business, you've got a higher one, things like that. So checking was in overdraft, I don't know, $500. Now, normally, if you just had that one account, that would be listed as a liability. But if you also had a savings account with $2,000 in it, and they were at the same bank, then you could list them as cash, $1,500. Okay, the 2,000 minus the 500. If they're at the same bank. Otherwise, if they were at different banks, this would be a cash, this would be a liability. Okay, you can read this section too. Now, foreign currency is of course cash, but we have to translate it to Canadian dollars. You do date of the financial statement, we'll be doing a bunch of that in 410. Okay, and you can read that. Just read through, make sure you understand what it says. Check in the book if you're not sure. Or Investopedia is a good place to look up definitions. They're usually pretty good and they're straightforward, unlike the text sometimes. Okay, so read all about cash. What is cash? What is not cash? Now let's go to accounts receivable, moving along the assets. Okay, so they're claims held against customers and others for money, goods, or services. Most receivables are financial assets or monetary assets, and they're described as either current or non-current. Trade, so that's the regular course of business. Or non-trade, so those would be things like dividend receivable, interest, government advances, refundable deposits, all different kinds. And then accounts receivable or no receivable. So, two-ish can complicate accounts receivable, discounts, trade, and cash. So trade would be for regular customers. Okay, so if you're a builder and you get a lot of supplies at Totem, a builder, a renovator, you can often get trade discounts because you're bringing in a lot of business. Cash discounts are for paying early, and they would be like $210, net 30, which means if you pay within 10 days, it's 2% off, otherwise you pay within 30. The other thing, now generally with short-term receivables, we don't deal a lot with interest. However, the longer the time between the sale and the payment, there's an element we may have to take into account. So measure them initially at fair value, present value. Receivables that are created in normal business transactions and are due in the short term are excluded from present value considerations. Because technically, present value means the time changes every day, right? Well, we're not going to do it for something that's due in 15 days. So the general exception they've made, normal business transactions with receivables due in the short term, we don't do present value calculations. Okay, so I'm just going to give you a brief review of recording sales. We did some of it last chapter, but it will be a little bit more straightforward. Recording sales when sales discounts are given can be done either the gross or the net method. In intro, you likely used the gross method, but I'm going to show you the net method as well. With the gross method, the accounts receivable are recorded at their gross amount, full amount. And if discounts are taken by the customers, we use a sales discount account, which is a contra revenue account. Now, in addition, if the amount of the potential sales discounts is material, a contra asset called allowance for sales discounts should be estimated and subtracted from AR. So lots of versions for reporting your sales accurately and not overstating them on the financial statements. Now, with the net method, accounts receivable are recorded at their net amount, so with the discount taken off. And if the discount taken by the customer, it's recorded in other revenue section as sales discounts forfeited. So let's just go through an example of gross and net. And they're not difficult, they're just, different way to think. So, June 3rd, Wild Horse Co. sold to Chester Arthur merchandise having a sales price of $3,000 with terms. As soon as it's got terms, it's on account. $210, net $60. 2% off if they pay within 10 days, otherwise they have to pay within 60 days the full amount. FOB shipping point, that means ownership transfers at shipping. An $86 invoice, terms net 30, was received by Chester on June 8th from John Booth Transport Service for the freight cost. Okay, who's going to pay for shipping if it's FOB shipping point? The ownership transfers at shipping. Well, the people who own it. And who owns it then? It transfers to Chester. So, that $86 invoice is Chester's responsibility as he took ownership, or they, the company, at shipping. Now, when it received the goods on June 5th, Chester notified Wild Horse that 510 of the merchandise had flaws that made it worthless. The same day, Wild Horse Co. issued a memo covering the worthless merchandise and asked it to be returned to them at their expense. So these are similar to what we did last chapter. The freight on the retained merchandise was $27, which Wild Horse paid because it was their messed up stuff. On June 12th, the company received a check for the balance due from Chester. And first we're going to, this should be down there. First we're going to record the gross selling price. So, prepare journal entries on Wild Horse. We don't care about Chester, assuming sales and receivables are entered at gross. So June 3rd was the sale. So we debited AR and we credited sales. So this is exactly like you did in Proper 5 or 6 of intro. We're using the gross price, the full price without the discount, so that's $3,000. Now, did we do anything about our inventory cost? No. But if we had an inventory cost, it would be debit cost of goods sold and credit inventory XX. Don't have the cost. Everybody good? Okay, now if they don't give you a cost, they don't expect to see that. Okay, just so you know. So June 5th. Chester notified Wild Horse 10 of the merchandise contained flaws. So they're returning it. So we debit sales R&A. Remember those? Returns and allowances for 510. And what should I credit? We're reducing sales. What should I credit? Well, they don't owe us as much, so it's AR. Now, just remember, that is a contra revenue, good, from sales. Okay. And if we had inventory, we would debit damaged inventory if we couldn't put it back in inventory, and credit cost of goods sold. Okay. Now, June 7th, Wild Horse paid $27. This was the return, and this was the cost of return. So credit cash for 27. And again, you guys, this is all in the merchandising transactions, part of your text. So if you're forgetting any of these or you're just confused, go back and look where you first learned it, and it should make sense. So this could be freight out, merchandise, return delivery, expense. The key thing is their expenses. 27. No, June 8th. No entry for Wild. Okay, so all we're missing now is June 12th, Wild Horse got money from Chester Arthur. So, June 12th, we received payment. Now, tell me, do they get a discount? They made the sale on June 3rd, or the purchased on June 3rd, and it is now June 12th. How many days did they have to pay in? 10. So 3 to 12, that's 9 days, so do you get the discount? So let's see what their little AR account says. Well, they bought $3,000 worth of items. Then remember on June 6th, they returned, or 5th, 510. So they owe us $24.90. Okay? Now, how much are they actually going to pay? Are they going to pay 100% of this? No. They get to take off 2% discount. So let's piece this entry together. How are we going to close AR? Well, let's do this. No, let me start over. Let's figure out cash first. So we get cash. Do we get the full $24.90? No, we only get $24.90 times, you take away 2%, so 98%. So that works out to 2440.20. Does that make sense? Okay. Now, our AR doesn't say 2440, it says 2490. What should be the balance in this account when we're done with it? Well, it's got to be 0. So we've got to close AR with the full amount, which is 2490. Now, we're short a debit of 4980, which, what are we going to call it? Sales discounts. And that will be subtracted from sales. Okay? So, big mistake lots of students make is they try and take off the 98% here, which leaves a little AR owing, which is, so always make sure you take the full amount off here. Okay, now I just want to kind of tie back to this chapter, and bear in mind these questions will be specific about how they record things, okay? So if Wild Horse originally had estimated a 1% return of sales for the initial sale, the sale entry would be under IFRS, they would debit AR for $3,000. Okay? They would credit a refund liability for 1%, which is 30. And then they would have sales of $29.70, which is just the difference, or 99%. And then as items returned, debit the refund liability and credit to AR. And then close this to revenue returns. And if it was ASPE, very similar, just the title's wrong, different. We debit AR. This time we credit allowance for sales returns for 30, and then credit sales for $29.70. And we close this to revenue if no more returns. Bearing in mind, you guys, if you're doing this for all your customers, it's always going to be cycling. This is kind of like allowance for doubtful accounts. It just sits there with a balance. Okay? Okay, so that's just tying it back to last chapter. So we did the gross, then we went, hey, what if they had these allowances set up that we heard about last chapter? And now we're coming back and going, forget the allowances, except now I want to do the net method. Okay? So, prepare journal entries on Wild Horse code books I can't read, assuming that sales and receivables are entered net of cash discounts. Then do everything there, and then do an entry. Let's say they didn't pay until the 29th. So, June 3rd, we debit AR and credit sales. Difference is it's not going to be 3,000. We're going to do it at the net method. So we're assuming the discount has been taken. So times 0.98, or 29.40. So you assume the discount will be taken. June 5th, same accounts. Everything's the same. Sales RNA and credit AR because they returned some of the goods because they were wrecked. And we have to do 510 times 0.98. So 499.80. Then on June 7th, debit, delivery, freight, expense, whatever you find on Wiley Plus. And that is 27. And credit cash because this has nothing to do with our discount. So finally on June 12th, we look at their little AR account. And we have 29.40, 499.80. And what do they owe us? 2440.20. Now, June 12th is with a discount. So how much cash are we going to get? Well, the 244.20 because it's already at a discount. And we can credit AR the exact same amount because it's not recorded at the full amount. It's at 98%. Okay. So this is all at 98%. I hope that makes sense, you guys. Okay, now we want to shift this up a little. And instead of paying on June 12th, they pay on July 29th, or June 29th, what did I say? Oh, July 29th instead. Discount, they're too late. So, tell me how much we deserve to get for cash. Well, we need 100%. So that AR is wrong. So how much cash should we get? Well, they bought 3,000 and returned 510. So we deserve 24.90. Don't get that mixed up with the 29.40. Wow, I couldn't have used worse numbers. Okay, this is the 100%. Everybody good? Why do we have to pay 100%? It says that's at 98. We assumed they were going to take the discount, but they didn't. So their AR is still sitting at this balance. So how much do we have to create AR? Well, it's sitting at 98%. So we're going to put 2,440.20. So how much are we out by? I'm just going to move it over here a little. 980. All I've done is subtract. Okay, so it's just the difference. And called sales discounts forfeited. And that goes, it's a revenue count with other revenue. Okay, remember in other revenue we said there were things like financing revenues that would go there, or interest. Same with this, is basically because of financing, so it's outside our regular operations. It's more incidental. Okay, so if they tell you to use net, remember net's always smaller, it's a smaller word, just like your paycheck. If you get a gross paycheck, you don't have any deductions. Net, they've taken deductions off, so it's a small amount. Okay, so that was just a basic review of sales at the gross and the net method when there's discounts.